All right, welcome back, folks, for another edition of Dirty Boots Capital. And we're here today with Noah Rosenfarb. He's a CPA, but also he's the founder of Freedom Family Office. And so when I saw that Freedom Family Office, I'm all about freedom. Anybody who watches the channel knows that runs through my veins. And that's why we do these things for the viewers. And so when I saw he was the founder of Freedom Family Office, I said, I got to have Noah on the show and talk about all that he does here. So, Noah, welcome to Dirty Boots Capital.
Thanks so much for having me, Tony. Appreciate it.
Yeah, this is going to be a lot of fun. We already started chatting before I hit the record button, so I know this is going to be a fun conversation. But why don't you bring the folks up to speed a little bit about your background, what you do, how you got to where you are, your CPA experience, and why you rolled from CPA into, so to speak, the founder of Freedom Family Office.
Sure, gladly. I'll give you the punchline first, which is I've done over 50 investments in real estate, about $1 billion worth of acquisitions. But my core focus is helping entrepreneurs pay less in taxes, ultimately to help them become rich beyond money. And by way of background, like to kind of bring you back to the beginning, grew up with a single mom. She always had two jobs, sometimes three. I always knew when it was payday. And my dad, in contrast, is a CPA. I'm a third generation CPA, and I saw that he owned a small business. When we went out to dinner, I could order dessert. Sometimes if it was raining, we might go to the movies and then go bowling. And I realized as a young kid, I wanted to have those choices in my life. And to me, that meant I had to focus on financial freedom. And so throughout my career, I've really been focused on how to achieve financial independence. And once I became financially independent, there was a shift in my philosophy to becoming, like I referenced, rich beyond money. And that's really what I help other entrepreneurs figure out, is not just how to gain their own financial independence, but then how to include in it a life that they love living and where they're making an impact on others that they feel proud of.
I love it. I love your story, Noah. And just to share a little tidbit, when young people actually ask me the question about, hey, I'm graduating high school, or I want an internship when I'm in college, hey, Tony, what should I do? What are your thoughts? But I share with them, there's two things. Knowing what I know today, there are two things, two internships that I would go after. And I swear these are the two things I share with them. Go work with a CPA, because if anybody knows how to I don't want to say sidestep the law, but use the law to their advantage, a CPA is going to know how to do that. And you'll be exposed to a lot of different creative things. So go work for a CPA for 1 or 2 years. And then the second thing is go work with a real estate attorney to understand the contracts and the ins and out of protecting yourself, and how to use real estate as a mechanism to create wealth. But also, at the end of the day, for you and me, we know it's about more freedom. Yes, wealth is good. Wealth is just a vehicle to get to more freedom. That's all we really want at the end of the day, is more freedom. And so if you can create more wealth, you can create more freedom for yourself. So those are the two things. I love your backstory of the whole CPA and third generation, and that's fantastic. And obviously, we talk a lot here on Dirty Boots Capital. We talk a lot about real estate, and I love that you've had a lot of transactions there. So one of the questions as I was preparing for this was, I want to get your take, being experienced in real estate, where do you see real estate going in 2025? Do you see rates going higher, lower? Do you think there's going to be a real estate boom or a real estate bust? What's your thoughts?
So my crystal ball is definitely cloudy. I think it's in part clouded by recent experience of this devastatingly fast growing Fed funds rate, which led to very fast growing interest rates on variable rate loans. And the result, I think we're seeing in the marketplace now, 20% plus declines on multifamily asset pricing of especially B and C class assets that were built before the turn of the century. I don't know if that price cut is deep enough to get people engaged in buying those assets and rehabbing them, and looking at where rent growth has been the last handful of years and deciding whether or not rent growth is going to continue. So I would say, while my crystal ball is cloudy, if I were investing fresh capital today, I'd likely be focused on equity structures where there's an existing first position mortgage, and now your equity is coming in beneath that 80% mark. So maybe you're filling the capital from 60 to 80%, or maybe from 60 to 75%, or from the 70 to 80% range. You're probably going to generate a mid-teens total return on that type of investment. And you could be placing that capital in what I would think would be growth markets where you've got preferably newer assets. So I would say if I really zoned in, it would be buying from a developer who may even be underwater in their project. And now you've got somebody that's going to take all the junior equity risk. You've got a lender that's taking first position mortgage risk, and I would want to be in between them, generating a relatively nice sized coupon, maybe a 6 to 8% coupon, and the balance of it getting paid when there's a refinance event or a sale.
Most people may not be in a position to be able to go out and kind of find that right property, right? Because that can be part of the battle, and then structure what that deal looks like and be able to bring in additional capital to maybe some of their own. So how does somebody go about structuring that and making that all happen?
So I think it depends what your goals are as an individual real estate investor. So there are people that want to become full-time real estate investors where they don't have anything else to do but focus on their real estate portfolio. Putting those people aside, because I think their career trajectory can vary along a great number of paths. And let's just focus on the high income earner who's working their desk job and trying to figure out, how do I generate passive income so that work becomes optional? And how do I take the capital that I'm saving from the excess earnings I'm generating in my day job and allocate them for growth and income? And maybe they've done well with Apple or Tesla or Nvidia, but they may also want to expose themselves to investing in real estate. Typically, they're going to get that exposure through a real estate syndication, investing in a single asset, or a real estate fund where they're investing in a pool of assets. And then when you're making those investments, you have to decide, what asset class are you going to be in? Do you want to be in storage? Do you want to be in office? Do you want to be in a multifamily? And again, there could be a lot of arguments for which asset class you might go into if you want to be diversified across asset classes. I believe that there are managers out there that I know, and they're just focused on that pref equity piece. And if you're looking to allocate your 50 grand this year, your 100 grand this year, your 200 grand this year, that would be my suggestion, is find a manager that's focused on that pref equity slice and go give them a bit of your capital and stay focused on your day job. Figure out how to generate the most value you can with your employer and get your biggest raise and your biggest promotion, and use that additional capital to invest outside in real estate.
Yeah, so there's a couple of things I definitely want to highlight. One of the things that I share with folks that you're talking about is we don't look to use real estate to create a second job for ourselves, right? We use real estate again to create more freedom. So that's where using this concept of investing in real estate passively through fund, through syndication, if that's right for you, for the investor, then that's the way to go about maybe maximizing your returns, because chances are, as an individual, you're working your job, you got your family, you got a lot of things already going on. To take on trying to find a property off market or on market, that's difficult. To be able to do the underwriting, that can be a difficult thing. To go actually out to the property, whether it's local or sometimes most likely it's not going to be local, to go out there and actually boots on the ground, look at the property, walk it, talk to property managers, and kind of get a CapEx plan together and really do your underwriting well, that takes a lot of time. That's a full-time job. And Noah and myself, we don't want folks to use real estate to create a second job for themselves. We want them to use real estate to create more freedom. That's our goal and our wish for people. So that's the first thing. So
maybe if I could share, Tony, one of the
sure.
concepts that I encourage investors to use is what's referred to as return on time. So we're all familiar with return on investment, which means if I put $50,000 down on this $200,000 condo that I'm going to repair and then renovate and rent and refinance, and I'm going to do my BRR strategy on it, that's great. I would encourage you to consider what the outcome might be, and your IRR might be 40%. That's awesome. But then look at your ROT. How many hours did it take for you to create that return? And from that value that you've created, subtract what you currently make in your day job. And if you're making 100 grand a year, that's 50 bucks an hour, and you put 100 hours into a project, well, now you're talking about 5 grand of the return that really just paid you for your time, and subtract that from the ROI calculation. So you could really get net of your time, what was your true return? And when you do that, it start to compare apples to apples with a passive investment opportunity.
Yeah, that's a great way to look at things. We're all experts in something, but it's hard to be an expert in everything. And putting together some deals can be, you need a team. you need a team. And so I look at it and I say, some of these funds that you referred to or syndication you referred to, there are folks who are experts in the office space environment, right? We've heard stories, read articles about the collapse of commercial real estate, primarily office space, really taking a tumble. And so, but there are folks who have these funds who really know how to turn that office space around and are getting great deals because it's a matter of supply and demand. There's great supply and little demand, so they can get a great price. They can negotiate the best price possible. Now, that isn't in my swim lane. That's not what I do, but there's other people who do that great stuff. So it's a matter of, yeah, knowing where you want to be in that space as an investor, active, passive, and then finding the right type of fund, whether it's commercial office space, self-storage, multifamily, retail, right? Some people like retail, really understanding where your interest lies. But for those first timers, like that really want to give it that go of maybe doing a fix and flip or something like that, you have a ton of experience in real estate, Noah. Where do you see, like in 2025, if somebody was like saying, well, I don't want to do a fund, I don't want to do a syndication, I want to do it on my own, which I have no problem with people doing that. Where do you see opportunity? Is it in retail? Is it in multifamily or single family, Airbnb, short-term
Yeah,
rentals? Where
I
do you
think
see
the
opportunity?
opportunity is in the buy and finding where you have a stressed seller where you have an advantage to solve the problems they're facing. So maybe your advantage is it's around the corner from your house and it's a place that you're obviously going to be able to stop by in the morning and stop by in the afternoon and continue to do your job effectively. Maybe you have a tenant. I just was working with a young guy who's trying to acquire his first large commercial project. And I looked at the deal. I was like, what is it that you have that somebody else doesn't have in this business? I got 3 tenants that are going to fill 15% of the occupancy. Great. Well, now you're putting a deal together that makes sense because you could buy it at 75% occupancy at the value of 75% occupancy. By the time you get to closing, you're going to be 90% occupied. You've created some value already. Now you're well on your way. And in the buy, what you want to be sure is you're not paying the seller for the value that you're going to create post-closing, that you're only going to pay for what exists today, but you've already in your mind figured out a path to solve that problem more efficiently than the market.
Yeah, what's your strength? What's your superpower that you're bringing to the table? If it's going to be tenants, if it's going to be if you're a general contractor, I get this from GC pretty frequently. It's like, hey Tony, I want to do what you do, but I don't have the capital to put into a deal, right? For the down payment. I'm like, yeah, but you're a GC. You have contractors, good prices. You can get better prices than I can, and you can do some of the sweat equity yourself if it's a fix and flip or if it's going to be a multifamily, or you have those resources probably better than I do, right? So that's your superpower. That's what you bring to the table, and yeah, you negotiate the best deal based on that. I love the fact that you advise on look for something that's distressed where you can go in and solve the problem of that seller, because we are seeing that. And it exists in every different asset class. Both you and I are in Florida, right? And I'm saying across Florida, we see these new subdivisions going up with MI, Lennar, KB Homes, Horton, DR Horton, right? They go in and they build 600, 900 homes, whatever. And they're able to offer the buyers a 3.5% 30-year fixed loan, 3.5, somewhere around there, right? They're different. They vary, right? But my point being, it's not 7% that you're going to get from a local bank, a local lender, right? Like if I'm going in to buy somebody's property that they're selling next door, a pre-existing home, single family home, I'm going to have to go and get a loan for nearly 7%, right? Whereas if I go buy a DR Horton home, I'm going to go get a loan from them for 3.5% or whatever they're offering right today. Who knows? But it's not going to be 7%. So the problem that existing sellers have today, the mom and pops that are trying to sell their homes in Florida, is they're competing with those big boys who are offering much better terms. And so until those mom and pops that are selling their home, reselling their home, until they realize that, they're going to struggle to sell their home. We see that happening all over the place. So I bring that up because maybe that's an opportunity for somebody to say, hey, I'm in Florida. I want to go do some Airbnbs, right? I want to do some short-term rentals. So maybe this is an opportunity where you can go buy a home, solve that problem for that seller to say, hey, I can't buy this home for what you want because I can't pay a 7% interest rate on that sort of money. So I need you to come down. So maybe they can get the buyer down 50K, 70K, whatever it is, where the deal makes sense for them now to go off and do a short-term rental. That's a distressed kind of situation that you can take advantage of. So just kind of planting that seed if that's something that's of interest to somebody. But one of the things that I'm looking at my notes here, my questions for you is in the last 18 months, maybe 24 months, we've had an issue of tighter liquidity, harder to get funding for projects. What do you advise there for anybody from a first-time investor trying to find funding for their deal to folks who are doing bigger deals, like a big commercial office or something like that? What do you have to say there?
I think the capital stack's been evolving. So I mentioned at the outset that I kind of like this preferred equity or mezzanine position in new assets. And I think a lot of the capital stacks are evolving back to multiple tranches where you've got first position debt, then you have preferred equity, and then you have junior equity. We weren't really seeing that at the last part of the cycle. We saw it after the great financial recession, kind of coming out of that in 2010, 11, and 12. We saw the capital stack get a bit more diversified. If you're just going to buy a single family home, and let's say you can get that first position mortgage based on your own credit, and now you need capital to fund. Well, how much of that capital are you going to bring to the table? If maybe you have 10% to put down and the bank's willing to lend you 70, well, you've got that 20% in the middle. Instead of filling it with just one investor that's going to be pari passu to you, or maybe you've got terms on the profitability, maybe you split it into two pieces and you find one investor that's a bit more conservative and they're willing to take 12% on their kind of position between 70 and 80%. And then you're willing to take another investor who says, okay, I'll take that 80 to 90% position and I'll take no yield on my acquisition until the closing. But when we close, I want a 15% total return plus 10% of the project profits, whatever the deals are. But I think you've got to be a little bit more creative in how you may finance a transaction based on the people you're speaking with and what their goals are for the investment. Because a lot of people are gun shy right now because maybe they've invested in a couple of deals that didn't go the way they wanted over the last couple of years. They've seen the interest rates skyrocket and now they're a little concerned. Well, what if we're not able to sell when we finish our fixed portion of the fix and flip and we're out in the marketplace to sell? What if the interest rates are up again? The Fed's cut rates 100 basis points and mortgage rates haven't really moved. So irrespective of where the Fed moves rates, it's unlikely that the mortgage rates are going to move in lockstep with any of these Fed fund rate cuts.
Yeah, we don't see the rates moving very much in 2025. We think they're not enough to be a game changer. Yeah, they'll probably come down a little, but it's not going to be enough to really move the needle on some of these deals. So I'm gonna bang the drum of you gotta be creative. You just have to figure that piece out. You got to think outside the box. You got to find out what other people are doing. And this idea of, say, for maybe smaller investors who are looking to do a fix and flip, if they go to the bank to get that first position, great, and they have another 30% to fill. Well, maybe that 30% is filled by somebody who's willing to hold a second note, not get paid any interest during the time of the fix and flip, but once it sells, that equity you gain based on the improvements you've done to the property, now you can pay out that investor their interest and maybe a little bit more based on them coming to the table to fill that 30% void that you had in funding. And so now you've created a situation where you have essentially maybe no money in the deal, right? The bank has the first position of 70%, and you have an investor, a private investor, coming in to fill the next 30% that's missing, and you have no skin in the game, no money in the deal. You want it to be successful. You need it to be successful in terms of being able to pay out your investors. But that's one way to kind of get the ball rolling for those folks that keep telling me, I don't have any money. I don't have any money. I'm like, well, go figure it out. There's a lot of ways to do it. And so I love what you bring to the table. I would be remiss if I didn't ask about what you all do there at Freedom Family Office and how you help people.
Yeah, so as I mentioned, we help high income entrepreneurs pay less in taxes. And part of the reason is to help them accelerate their achievement of their financial goals. But then what we want to do with that capital is develop a passive income strategy so that they have work become optional. And usually we're investing that capital in the publicly traded markets as part of our family office services, and then in the private markets, both in the real estate acquisitions that we're making directly, in other people's real estate transactions, and private equity, private debt, and helping them come up with their overall asset allocation that fits with their goals and objectives. And of course, wrapping in the tax piece and helping them identify when is the right time for them to exit their business, and what would that transaction look like, and how do we make sure that when they no longer own their business, their life is better than when they owned it.
I love it. I love it. There's so much there to analyze with someone, and to be able to have someone to talk it through, someone with experience like yourself to be able to have this conversation, you be able to lead them and ask them pointed questions that they didn't even think about. That's a game changer for folks. I'm going to share it because I have those conversations with folks who want to get into real estate and they want to do certain things. And I'm like, why? Well, what's your goal? And sometimes they're not thinking about depreciation as a way to reduce their tax basis. And so once you ask them questions, it's like, oh, I didn't think about that. So having super smart people like Noah to have these conversations with is important. So Noah, if folks want to reach out to you, where can they find you? Either social media or an email address? What's the best way?
Sure. On LinkedIn, Facebook, Instagram, Noah Rosenfarb. Happy to connect with you there. I share content about real estate, of course, but also investing, insurance, taxes, lifestyle. And we always have good tips and tricks that we're sharing and what we're doing. And for those of you that are interested in speaking with the team of accountants, lawyers, and financial planners that we've assembled, you could go to talkabouttax.com and that'll get you on a call. And again, the kind of initial minimum clients we serve are 7-figure income or 8-figure net worth entrepreneurs. So that's really the people we work with directly.
Excellent. Well, no, I appreciate you. I appreciate your time coming on to chat with me, to educate the viewers and give them some things to think about. So thank you so much for joining us here on Dirty Boots Capital. And yeah, folks, I encourage you, go check out the website, go reach out to Noah on his social media, get to know him, check out the free content he's putting out. There may be something he puts out that sparks the flame to get you thinking in a different way, a better way to help you achieve more wealth and freedom. So Noah, thank you so much for your time today.
Thanks, Tony. Appreciate it.